What will it take for disillusioned investors to return to the stock market? I'm joined now by Wharton professor Jeremy Siegel. Professor Siegel, thanks for joining us.
Happy to be here.
We have seen a level of risk aversion that's continued in terms of the stock market. Investors moving their money into bond funds, still some skittishness between the recession and everything else that's gone on. How would you describe this current level of risk aversion? Is it unprecedented or part of a cycle?
Honestly, I have never seen it so high in all the years that I've been watching the markets. The only comparable time, and most of this is old timers, older than I, say this is the way it was after the Great Depression. After 1929 and the crash, it took about 20 years for people to get enough faith back to begin to go into stocks. Now, I don't think it's going to take anywhere near that long now because the situation isn't as bad as it was. But this is certainly the most risk aversion that I've seen in probably 50 years of the market.
Professor, what will it take to have the disillusioned investor come back into the market? Will it be one particular event or a series of confidence builds?
I think confidence will build as time moves away from that terrible 2008-2009 panic and bear market. I think if people see that we're not going to be slipping into another serious recession or depression, and in fact some of the things I see are getting a little encouraging about a pickup of employment and the economy, I think that people will get their toes back into the market. It'll be slow for many of them depending on how much they've been hurt. But I think that by early spring, if they can see the markets up and the economy finally beginning to pick up some steam, we might get some of those people back in.
If those people, or when they go back in, will their method of investing be somewhat different than in past moves back into the stock market, either the use of more options, puts and calls, or ETFs, or is there something about the way stock market investing might change going forward?
I think a lot of them now are looking for yield and safe yields with interest rates near zero. As we know, I have more people asking me, well, what about dividend-paying stocks? What about stocks that not only pay dividends but have their dividends well covered by earnings so that there's a very good chance that they're going to continue on that? So I think that's the conservative play for investors over 2011 is well-positioned dividend-paying stocks, paying 3, 4, 5% on their money, much more than you can get in the bank or on funds, with that good possibility of gain if, as I believe, the economy moves forward.
Have you changed your opinion at all about stocks as an investment vehicle? Are there alternative investments now, whether it's commodities or commercial real estate, once there's a bottom, that might provide a better source of return long term?
Well, you bring up a very important point. Back in the 70s and 80s, it was plain vanilla. You either were in stocks or bonds or money fund. And now we know there's a lot of other types of investments. Real estate has always been a huge investment class, but I think several others have been overhyped. For instance, I'm concerned about commodities. I'm concerned about gold. And when I say concerned, I think too many people have piled into these, and I think they're going to experience disappointing returns. Gold in particular, in the short run, it'll probably continue to rise, but long term it may not. So there are alternative classes, but right now when I look at them, I see a lot of those are overpriced.
So we have not seen double-digit stock returns in many, many years. Is there a new norm in terms of what investors should expect from a stock market return? Are those old historic, 8 to 11% really not as valid going forward?
Well, certainly you bring up a concern that I hear all the time. Bill Gross of PIMCO, and I have the highest respect from him, he speaks of the new normal, which is slower economic growth and lower stock returns. Now, my research shows that after inflation, 6 to 7% per year. Now, you quoted 8 to 11 with a good 3% inflation. That does coincide to what you often hear out there. He is very pessimistic, but my own research says that long-term stock returns are a function of productivity growth. And of all the variables out there, productivity has been doing very well, and I expect it to do well over the next decade. But I think that we're going to have good productivity growth, and for that reason, and from these very reasonable levels of valuation we see today, I think 6 to 7% after inflation will not be difficult for stock investors to realize over the next 3 to 5 years.
Professor Siegel, thank you very much.
Thanks for having me.
I'm Rhonda Schaffler. This is Reuters.